Good afternoon, everyone, and welcome to the Capital Group YouTube channel. I'm Rob Hannan, the Director of Wealth Advisory here at the Capital Group. And today we'll be spending about an hour with our team of experts to break down everything from the recovery to the downturn, and even discussing the looming election and how it will affect the overall market. In the world of COVID, we've seen continued volatility and want to shed some light on how to invest in this uncertain world. Throughout today's program, I will be monitoring questions and we'll be getting them out to our panel of experts for discussion. Please use the YouTube chat right here on your phone to submit your questions. We will get to as many as we can, but if we run short on time, don't worry, feel free to contact us so we can help get you an answer. Our contact information is also posted below and will also be posted at the end of this webinar. And this program is also going to be recorded, so you can certainly rewatch at your convenience. With that, I want to welcome our panel. First, we have Eric Friedman, who's an Associate Chief Investment Officer here at the Capital Group. In his role, he heads up the Internal Investment Committee, as well as overseeing the investment due diligence process for pension, 401k, and individual wealth management clients. Eric received a degree in finance from the University of Pittsburgh, and he is also a CFA charter holder with extensive knowledge in the capital markets, working closely with outside money managers to best manage our clients' needs. One such partner is Brinker Capital. And today, from Brinker Capital, we have Tim Holland. Tim is a Senior Vice President and Global Investment Strategist at Brinker. In his role, Tim works with senior members of the investment team to develop and deliver Brinker Capital's macroeconomic and capital markets outlook, including the company's investment views and portfolio positioning. He is also the Vice Chair of the Asset Allocation Committee and has 20 years of investment experience. He is also a CFA charter holder. His commentary can be found in various business media outlets, including CNBC, Fox Business, the Wall Street Journal, and many others. So with that, I'd like to get things kicked off. Eric, take it from here.
Thanks, Rob. And thanks, Tim, for being with us. Obviously, it's no secret that the last 4 or 5 months have been challenging, to put it lightly. Whether it's through our professional lives, learning to work remotely from slightly downsized home offices, or in our personal lives, trying to cope with communicating largely over digital platforms, and in some cases, taking the role of part-time teacher for our kids. The last few months have brought some large uncertainties and new normals. With that said, it's no surprise that the economy has reacted similarly, with volatility throughout the capital markets and across the economy as a whole. Tim, would you mind bringing us up to speed on the last few months?
No, I'd be happy to, Eric. It's good to see you. It's good to see Rob. We appreciate the ongoing partnership between our two firms, and on behalf of everyone at Brinker Capital, to all of you that are watching this broadcast, we hope you're all well and safe and healthy and navigating this very difficult period, as well as can be expected. To Eric's point, it's been an unprecedented market and economic cycle. So what I'd like to do, Eric, is spend just a couple minutes rewinding the clock a little bit right before this awful pandemic hit, and then the response to the pandemic from a market and an economic perspective. And this is obviously first and foremost a healthcare crisis. And our hearts go out to anyone impacted by this awful virus from a healthcare perspective or a financial perspective, or both. But as investors, we need to obviously understand the impact COVID-19 has had, will continue to have on the economy and the markets, and position our clients' capital accordingly. So if you back up a little bit, our first slide is headline, "Everything was awesome." Because if you go back to January, early February, things were really good, right? We had a great year last year in the US stock market. The economy was growing 2 to 3%. There was little signs of excess. Inflation was under control. It may be hard to remember, but we were all living through the longest economic expansion and the longest bull market in our country's history, right? Those two things were running in parallel. And if you remember last year, the big overhang for investors was the US-China trade dynamic. That was the big question mark. That was weighing on corporate sentiment and spending, and we had solved for that. So as we came into 2020, as an investment team at Brinker Capital, and we've been allocating capital for our clients for north of 30 years, we were pretty optimistic that with trade out of the way, little signs of excess, global growth would pick up and risk assets would do well. And lo and behold, that's what happened. The S&P 500 traded to an all-time high in late February. But on the next slide, right, everything was great until it wasn't. And obviously the catalyst for this very unusual market economic cycle was this awful virus that was first identified in China, spread quickly to other countries, and countries just started to lock their economies down to try and mitigate the impact of COVID-19 and to slow its spread. And we were largely insulated from that first wave, again, up until the back half of February. And investors then began to appreciate that policymakers here at home were going to follow a similar path, and that was stay home, right? The US consumer, which is 70% of the world's largest economy, was going to be asked to shelter in place. And as that started to be priced into markets, both fixed income markets and equity markets, well, a couple things happened. Equity sold off dramatically, and the bond market just stopped functioning. And while no one wants to see stocks go down in value or bonds go down in value, the one thing that's worse than that is bonds and stocks not trading at all. So things were looking very unpleasant, both from a real economic perspective and from a capital markets perspective. And per the National Bureau of Economic Research, the economy ended that longest ever economic expansion in February and went into a recession. And the downturn was unprecedented. And we lay that out on the next slide in visual form. There are 4 economic graphs up on the screen that hopefully folks can make out. I know it's a busy slide, but we haven't seen a downturn like this since the Great Depression, right? The early 80s doesn't compare. Even the Great Recession of 12 years ago doesn't come close. And we wanted to highlight a couple of the graphs up on the screen to try and put this downturn in perspective. So in the upper left, you'll see initial claims for unemployment, right? Now that's how many people in any given week are filing for unemployment insurance. The record before this awful pandemic hit and this healthcare crisis caused an economic crisis was 675,000 Americans in 1982, which was a terrible double dip recession. In late March, 6.9 million Americans filed for unemployment insurance, right? And if you look right below that, we had the quickest path from bull market to bear market in our country's history. A bear market's defined as an S&P 500 correction of 20%. We got there in 20 trading days. So the downturn was without precedent, or at least without precedent in the post-Great Depression period. And the next slide, we lay out 4 more graphs that speak to, again, the unprecedented nature of this period of economic contraction. And I'd highlight 2. Upper right, at least the way I'm viewing the screen, the unemployment rate spiked to 14.7%. Before this pandemic hit, US unemployment was at 3.5%. It was a 50-year low. And in a matter of months, we went to 14.7%, and 20.5 million Americans lost their jobs in April alone. And the CBOE volatility index, commonly referred to as the VIX, spiked to an almost a historic high, which reflected, to your point, Eric, the volatility in the market. So this downturn, which has already ended and the economy is recovering, it really only lasted about 3 months, but the severity of it is really unprecedented, at least in a post-World War II period. It's been obviously a very tough 2020 for millions of Americans. But fortunately, things have gotten better, and I know we want to talk about that as well.
Yeah, well, I mean, frankly, with so much uncertainty and such unprecedented and frankly fast downturn, it's obviously no surprise that we saw such fast, unprecedented, and maybe even drastic responses from the federal government as well as the Federal Reserve. Why don't you take us through some of that response?
Yeah, no, I think you hit the proverbial nail on the head. If there's one thing that I think we all need to focus on, if you had to pick one thing about this cycle and what put a floor under risk assets being stocks and bonds primarily, and put a floor under the economy, it was an unprecedented policy response. And we lay out the highlights of that response on slide 6 in the presentation. So you have this unprecedented downturn, contraction in GDP, 70% of the US economy, us, right? We're told to stay home. We're the world's largest and most important economy. And so the downturn was just terrible, the rate of contraction. And so what we needed from an economic perspective is what we've described as a bridge loan, right? A loan to get all of us from here to there. and there being the other side of this pandemic when the economy could start to reopen. And the idea was if you could keep as much of the real economy in place as possible, and by that we mean companies and workers, once you got to the other side, the economy could inflect higher and you'd minimize the long-term structural damage from this awful virus, right? And there are only two entities in this country, maybe in the world, big enough to put in place a bridge loan for an economy that's worth about $22 trillion. And that's the Federal Reserve, our central bank, and the federal government, right? And so the Fed moved first under Chairman Jay Powell. They took interest rates to zero. The bond market we talked about earlier wasn't behaving. There was no liquidity. Trades weren't clearing or getting done. And so the Fed injected trillions of dollars into short-term lending markets, and they've launched an open-ended securities purchase program. They essentially have $2.5 trillion on the Fed's balance sheet that they can use to buy things like mortgage-backed securities and treasuries, all with an eye towards pushing liquidity lending into the real economy. So the Fed goes first, the federal government goes second. President Trump, Speaker Pelosi, Majority Leader Schumer put in place 4 COVID-19 rescue packages, the most meaningful being the $2.1 trillion CARES Act, right? And it was that backstop from the federal government and from the Federal Reserve that largely put a floor under the market bottom on March 23rd, and put a floor under the economy and created confidence within the private sector that people could put capital to work. So I know we're living in a very difficult period politically, culturally. I'm of the opinion that when historians write this stretch of American history from a policy perspective and what these policymakers confronted, they'll give them better than passing grades, and I think they should. But to put that response in visual form, the next slide does that with 2 graphs. And on the left-hand side, you should see the Federal Reserve's balance sheet, which has spiked to north of $7 trillion. I'm sorry, I think I went backwards. I need to go forwards. My apologies. So the Fed's balance sheet is up to about $7 trillion all in. And the fiscal stimulus side of things, right? The federal government's responsible for the fiscal policy. The central bank is responsible for monetary policy. That $2.1 trillion CARES Act dwarfs anything that was done in response to 08 and 09. And then a couple other slides or comments, if I could, around the response from the markets and then the economy to get back to the idea that things have gotten better. Risk assets bounce back meaningfully. And again, I apologize. I've got to catch up with the slides, so I'll just keep talking if that's okay. But slide 8 talks about how the bond markets started to clear. There we go. Sorry about that. There's been a massive amount of fixed income issuance, a record amount of debt being issued by companies, and the stock market, the S&P 500, has rallied about 40%. So the fastest bear market in our country's history, and a big bounce back. We were asked through the second quarter, how could the market be going up in the face of awful economic data? And our answer was pretty straightforward. The market's forward-looking, so it can go up in the face of terrible data. It was pricing in an unprecedented policy response, and it was pricing in the fact that the economy would turn, that the economy would inflect higher, and it did. And so on slide 9, I believe we've got a couple graphs that speak to that bounce back in risk assets. On the left-hand side, you'll see the S&P 500 year to date through the end of June. We update these slides on a quarterly basis because of compliance, and we like to take a long-term view of things. But the S&P was up, again, meaningfully to start the year, corrects 34%. And now, as of late July, we're actually positive, flat to slightly up for the year. So it's been an amazing 6-7 months. And then if you look to the right, you'll see how certain parts of the market bounce back, with small cap stocks up well over 40%. And you would expect to see that as investors became a little more optimistic. Small cap stocks tend to be a little more volatile, but they should lead to the upside. And that's a good sign, we think, for economic growth down the road. And then the next slide, slide 10, looks at a couple data points from the bond market. Most of us focus on the stock market. It's incredibly important. That's where most of our money probably is invested. I'd argue the bond market's more important. It's bigger. It's where companies go for capital on a daily basis. So if you look on the left-hand side of the slide, you'll see something known as a high yield options adjusted spread. And when that line is towards the top of that slide, it means it's really expensive for companies to borrow. And when it's towards the bottom, it's really cheap. And so when the Fed came in and started to buy high yield bonds and promised to support markets while borrowing costs dropped dramatically. And year to date, over $1 trillion in investment grade bonds have been issued. And the final point I'd make about the Fed's response, as I mentioned earlier, the Treasury essentially credited the Fed with $2.6 trillion to buy things like corporate bonds and muni bonds. The Fed's only spent about $100 billion. Just Jay Powell and the Fed promising to buy these fixed income instruments, promising to support risk assets, was enough to get the private sector, the banks, all of us to say, we're going to be okay. So that's why the Fed still has $2.5 trillion in capital on their balance sheet, which is just a stunning amount of money where things have become difficult again, but we're obviously more optimistic than not. And then a couple slides on the economy. So if we go to slide 11, right, risk assets go first, they're forward looking, and then the economy comes second. So that's why the economy could look as bad as it was, and it was in March and April and May, and the stock market and the bond market could be going in the right direction. So that's how it works. What was interesting about our calling a bottom in the economy in April is that the classic economic data still looked terrible, right? Today, it's, what is the date? It's July 30th. We just got our first look at Q2 GDP. It was off over 30%, right? But that's rear view mirror data. So the neat thing, if there's a neat thing about an awful recession like we just lived through, is we've got a data set that we've never had before, things like open table reservation data. And that real-time data started to tell us that things were getting better in April. And we thought that was the case. And then on the next slide, slide 12, I believe, the conventional data started to catch up. I talked about that unprecedented spike in unemployment claims, almost 7 million in 1 week. That's down to 1.3, 1.4 million. That is still a shockingly high number. The economic damage this awful pandemic done is great, and it will be with us for a very long time. But this unconventional data set that we really didn't have 12 years ago, that started to improve first, and the conventional data started to improve second. So we've got a broader toolbox and a deeper toolbox as investors and strategists than in any other prior period in our respective professional lives, which is, there is an upside about going through this. Maybe that's from a professional perspective, one of them. But hopefully that wasn't too much on the bounce back in the economy and the markets. But let me turn it back to you, Eric, if I could.
No, I think it's all good info. And frankly, where I'm sitting, all in all, looking at the response and the resulting data, it seems to me that it would be safe to say, at least the early results that we've seen come in, point to a policy success.
Yeah.
With that said, I also think that it's not safe to say we're quite out of the woods yet. Off the top of my head, there's still a lot of uncertainty looming over the COVID vaccine, improvements in treatments with cases rising, and the employment environment across the country, just to name a few.
Yeah. No, I think that's a very sober way of looking at things, right? You know, the Fed and the federal government put a floor under sentiment, the economy, risk assets. You've had a big bounce back. The fundamental data has improved. Earnings are coming in obviously down dramatically for Q2 year over year, but better than expected. But we've got a long ways to go. And so that policy response was unprecedented. We thought justified given what we were facing from an economic perspective. Excuse me, but it really needs to persist. We just don't think the economy can stand on its own just yet. And so you need that support from the Federal Reserve and the federal government. We do think, though, that this massive move higher off that March 23rd low, when the market was off about 34%, has been justified. And we do think that low will prove to be the bottom. So we built something called the Brinker Capital Bear Market Bottom Checklist, which we feature on the next slide in our presentation. And the idea is, if you can go back to March, which isn't all that long ago, I mean, it was a very frightening period, right? What was going on in fixed income and in equities here and around the world, and the economic data and so on. And you know, you realize when you're in that kind of environment, you know, a couple things if you've been doing this for a while, and obviously all of us have. One is that the market's going to stop going down before the data gets better. And if you wait for the data to get better, you're going to miss a massive move higher, right? The proverbial rubber band is pulled so far back. So we thought that March 23rd low in the S&P, when it traded down to about 2100, would prove to be the low, and the checklist really helped. And if you look at the checklist, it's a series of data points that tend to present themselves at bear market bottoms, and we use the two most recent bear markets as our sample set. And I think what's worth pointing out about the data set is none of it is economic, right? It's not GDP or retail sales, because that's going to look terrible. It's things like extreme investor pessimism, a massive policy response, extreme volatility. So we felt comfortable saying, okay, that's it. The selling has exhausted itself. Fortunately, knock on wood, that's proven to be the case so far. Obviously, we hope that persists. So we do think the worst is well behind us from a market perspective. But to your point, we still have some wood to chop. Near term, we speak to our expectations around the market using another tool that the Asset Allocation Committee built called the Brinker Capital Market Performance Probabilities Grid. And this is our best thinking broken up into 4 likely scenarios, and we weight them. And as we think about where we are right now, late July, almost August, as you know, Eric, it's a seasonally weak period for stocks. The old sell in May and go away, right? It's a tough time of year for equities historically. You have the uncertainty around the election, and we've had this massive move off the bottom. And we're really happy we participate in that. But our best thinking is a market that's going to be range bound and volatile, most likely up a bit or down a bit, some very unpleasant days. But if you can get to November and you get those votes counted, if history's any guide, you're probably going to move higher to year end. So longer term, we're optimistic, but near term, we're a little more cautious. We expect more volatility for all the reasons I just articulated. And another way to think about what the market may do after this kind of move higher is just go back and look at prior periods of just massive, very truncated gains in equity. So the next slide takes this 40-day rally in the S&P 500 as of May 19th. So it's a bit dated, but that 40-day run was the second best 40-day run in the history of the index. And what's kind of interesting, if you can make out, I'm sorry, I need to go to slide 15. If you can make out the different periods where the markets had meaningful moves higher, they tend to come at the bottom of a bear market, right? Because there's such extreme selling and pessimism, it doesn't take much for the market to get going in the other direction. And then if you look left to right, you see what I spoke to earlier. The market tends to be range bound following that kind of move higher. But if you look out 6 to 12 months after the kind of gain we've just seen, 40% off the lows, the market's almost always higher and meaningfully higher relative to what history tells you to expect. So that's our best thinking near term. And then obviously, you transition from the market to the economy, and we start to lay out our thinking on the next slide around this economic cycle, because ultimately the markets will lead the economy, but they're not going to disconnect from each other. We heard that a lot in the second quarter. They're disconnected. We didn't think they were. Sooner or later, the economic data has got to confirm the market one way or the other. And so when we think about what comes next for the economy, we've talked about pick a letter, any letter. It was on the front page of the presentation, because people in our business, Wall Street, investments, strategists, tend to use letters to try and determine or communicate what they think the economic cycle will look like. A V is probably the best you can hope for, or a J, shallow correction followed by a big bounce. Clearly, the economy started to go up in May. So the expansion is underway. Near term, it looks like a V. You've had a big move higher in the fundamental data, retail sales and unemployment. We've taken this sort of L scenario off the table where the economy goes down a lot and never recovers, but we're just not yet sure what the long-term trajectory of the recovery is going to look like. There's just too many unknowns. And as we lay out on this slide, even though we're going in the right direction, a lot of the economic data is backward looking. So we need to be prepared for awful numbers like the one we saw today, where Q2 GDP, it's almost unfathomable, contracted on an annualized basis about 34%. We've never seen anything like that since the Great Depression. But it's also, again, worth keeping in mind that most of those numbers are going to be telling you where the economy was, not where it's headed. But we're obviously spending a lot of time as a team trying to determine the shape of the recovery, because that will have a big impact on how we allocate capital. And so my final comments, or a couple more comments, if I could, on the shape of the recovery, are laid out on slide 17. We think there are three big variables that are going to drive this recovery, right? The first is the effectiveness of the policy response. How much of the real economy was the Fed and the federal government able to keep in place? It's one thing for a business to be shuttered for 90 days. It's something else for the business to just liquidate. It's one thing for an employee to be furloughed for 60 days. It's a whole nother thing for that employee to lose their job altogether. So I think policymakers have done a good job, but that's something we're paying attention to. How quickly we reopen the economy, and then how we all behave as the economy reopens. Policymakers will remain engaged. Jay Powell is the chairman of the Federal Reserve. At his June Fed meeting press conference, he was asked about raising rates, which would make capital more expensive, slow the economy. And his answer was great. It was, we're not even thinking about raising rates. And they're talking about another COVID-19 rescue package in Washington, D.C. I know you all are based just outside our nation's capital. So, you're really knee deep in it down there. Those negotiations are not going all that well right now, but we think they will come to some agreement because, again, the economy just can't stand on its own just yet. The final point I would make about the shape of the recovery and the reopening of the economy, and this is my opinion, I don't think we're setting this economy down again. I think some states will take a step back, sometimes two steps back, but the economic and societal consequences are too great. And as the father of two young children, I think the only way we shut the economy down again is if we find out, God forbid, that this awful virus impacts young people in a way that, fortunately, thank God, it doesn't seem to. And a few more slides before I turn it back to you, Eric. Slide 18, reasons to be concerned about the recovery, right? The big one is COVID-19, coronavirus, as you talked about early on in our presentation today, a second wave or an elongated first wave, permanent structural damage to the economy. People need to get their jobs back. They need to get back into the labor force so their skills don't atrophy. The government steps away from a fiscal perspective. We don't think that's going to happen. And then you have this U.S.-China dynamic, which now goes way beyond trade. And we think that's something that's going to be with us for a very long time. And you've got the election, which is obviously coming up quite quickly. So there's a lot out there. But there's also reasons for optimism, and we lay those out on the next slide. And those would include, housing. The housing market is exceptionally strong right now. This is not 08 or 09. We're investors, but I think we all know that most folks don't have meaningful equity or fixed income exposure. If they own an asset of any significance, it's their house, and the housing market's in great shape. The economy continues to reopen. Again, 2 steps forward, 1 step back, but that's okay. It won't be linear. And the other point I'd make, at the risk of sounding Pollyannish, is we're devoting an unprecedented amount of intellectual and financial capital to tackling the coronavirus. So I just finished reading Steven Pinker's Enlightenment Now, brilliant writer, brilliant professor. And the book came out just before this awful pandemic hit, but there's a whole section on healthcare and tackling things like malaria and smallpox and measles. So we've faced bigger challenges than this. We will solve for this. That is not blind-eyed optimism. That's not a Pollyannish worldview. History tells us that we solve for these kinds of things, and we will. And if I was a betting man, I'd bet sooner than later. So again, hopefully that wasn't too much, Eric, but let me turn it back to you.
No, I appreciate all the info. And I tend to see it very similar to you. I think that even in light of today's GDP numbers, and there are reasons to be maybe a little cautious going forward, I think there's all a fair amount of reasons to maintain cautious optimism.
I think you're right. And to that point, if I could, if we have clients that are a bit nervous, or maybe they've participated in this big move higher and they want to take a couple chips off the table. Obviously, everyone's different, or maybe they've got capital to put to work. The next couple months should provide windows to put money to work at probably more attractive prices, at least U.S. equities. But at the same time, if you've participated in this just massive move higher, some near-term volatility, some unsettled markets is probably what we're going to get. And, nothing wrong with cashing in some chips as well, considering where we are right now, I think.
Yeah, I think that's a pretty safe bet, especially You've alluded to this a few times. I'm sure a lot of our viewers are very interested in the results of the upcoming U.S. election.
Yeah.
On the corner. I'm sure some consequences from that maybe you can speak to.
Yeah. So one thing we do at Brinker Capital is on a quarterly basis, we survey the financial advisors we work with, like you and Rob and your peers and financial advisors across the country, because everything we've done at Brinker has always been with, through, and for financial advisors, right? And I know you've heard me mention this before, but it's because we have a deep appreciation of the value that the advisor creates in their client's life, especially when you go through 6 months or 5 months like we've just gone through. So on a regular basis, quarterly, we survey the financial advisors we work with. We've done this for several years. And one of the questions we ask, we lay out on the next slide, slide 20, and that is the current domestic and or geopolitical dynamic having a meaningful impact on client behavior? And over 60% of financial advisors in the second quarter said yes. So as we all know, Eric, right, we've been doing this for a long time. There's lots of reasons to buy or sell a stock or a bond or allocate capital to one strategy or another. Politics shouldn't be one of them, right? Politics is the art. I like to say that one has to practice successfully to have the right to implement policy, but they're very, very different things. But we do want to talk about the upcoming election because even though it hasn't been on the front pages, because this awful pandemic, as the coronavirus is hopefully brought under further control and we get closer to November, it's going to be more and more top of mind. So we lay out a couple thoughts around November 2020 on slide 21, I believe. And there are a couple of things. One is it's a long ways away. I know it's only a couple, 3-4 months away, but that's a long ways away, right? And so there's lots of things for us to concern ourselves with. That's not necessarily one of them just yet. I'm not saying don't be involved and pay attention to the news and different positions from different candidates, but if you're worried about your portfolio vis-a-vis the election, I would set that aside just because the calendar tells us so. We have months to go. And again, the politics is very different from the policy. The policy is going to be driven by whomever controls Capitol Hill and whoever sits in the White House. A couple other thoughts. We're economists and investors. We're not political scientists, but obviously it's something we pay a lot of attention to. In our opinion, this is not a national election. This is 2016 part 2, which means a handful of states are going to decide the Electoral College and whether or not Donald Trump wins re-election or if Vice President Biden becomes the next president of the United States. But all this is playing out with a backdrop that's really unprecedented from a cultural and a political perspective. And now you have the first pandemic in 100 years, give or take. And I was talking to our chairman and founder earlier today, Chuck Widger, who I know you and Rob know well. And Chuck's in his early to mid 70s, and he was talking about the late 60s. And he said, from that perspective, it hasn't felt like that up until now. That was worse, he said, but right, clearly this is a very challenged period for us politically and culturally. And that uncertainty, that angst just kind of bleeds into volatility or can become a compounding dynamic in terms of how people view the market and behave. And, we've got a chief behavioral officer at Brinker Capital, Dr. Daniel Crosby, and I know you and Rob know him well. And if you go to our insights page, he's produced great content on how all of us can manage through very stressful periods and make better decisions. So I would encourage folks watching the broadcast to do that. But if I was to bring it back to policy and politics and how all that may come back to the market, on slide 21, there's a graph up there with our talking points, and it just shows tax rates for corporate tax rates and dividend income. And before President Trump signed those tax cuts, the rates were much higher, and now they're much lower. And I think if there's one point that people are maybe worried about from a market perspective is what does the election ultimately mean for fiscal policy, specifically taxes? Because I don't think, my personal opinion, that President Biden is going to want to cut spending or President Trump is going to want to cut spending. So it really comes down to taxes. I'm of the opinion that even if you get a wholesale change in DC, meaning the Democrats take the White House and the Senate, I don't think you're going to see a meaningful change in fiscal policy next year. It's my personal opinion. The basic idea being that come January of next year, we're going to be 7 or 8 months into this recovery. And I'm not sure the politicians are going to want to raise the cost of capital on businesses and Americans just because the recovery will be so nascent. But I think that's really the big issue that most people come back to. And at the risk of sounding flip, I'm not that concerned about that, at least through 2021. And then if we move to the next slide, a couple other thoughts, if I could, around the election. If you want a crystal ball, someone to tell you something to tell you who might win the vote come November, at least from a presidential perspective, you can do a lot worse than consult the market. So on the left-hand side of the slide up on your screen, we look at the performance of the Dow Jones Industrial Average, which has been around for well over 100 years, in every presidential year going back to the late 1920s. And what's sort of interesting, it could be causality, there could be some correlation. We think there's some correlation there. Whenever the Dow Jones Industrial Average is up for the 3 months prior to the vote, so that's August, September, October, doesn't matter how it gets to the upside, as long as it's positive, the party that holds the White House going into the election has held on to the White House about 80% of the time. So that could either be Ronald Reagan following a very tough late 70s run for Jimmy Carter, and so Jimmy Carter lost the White House, or it could be George H.W. Bush holding the White House for the Republican Party in 1988. So come November 1st, if you want to have a pretty good idea who might win, just do the math on August, September, and October. And if the Dow's up, odds are Donald Trump will win re-election. And then on the right-hand side of the slide, we look at return streams in election years. And I talked about being in a seasonally weak period for equities. September is historically a down month for the market. October is a down month during the election year. So if history is any guide, equities will be volatile through election day and then rally into year end. And that's our base case. That's our near-term outlook for U.S. stocks as we move further into 2020. So let me turn it back to you, if I could, Eric.
Sure. Yeah, well, that's all great information. I think that all the noise, I think it goes hand in hand with sort of the central investment philosophy that governs our portfolio construction. I don't want to speak for you, but I'm sure I think we share this, which I describe as sort of a reliance on the traditional, maybe on the proven. So
yeah.
Whether it's focusing on diversification, favoring liquidity in asset classes, and really focusing on drilling down each investor's risk tolerance and time horizon. The goal is really just to help every investor feel comfortable looking past all this noise, looking over, towards the ultimate goal, which is really just realizing the long-term, most optimal outcome for everyone's unique situation.
No, that's a great way to think about things. That's how we think about things. So to that point, I want to jump ahead a couple slides. We've got a couple slides in the presentation that talk about the debt and the deficit, because we are running historically high deficits right now to pay for this federal fiscal response. But I think I'll make one quick comment about that, but really get to slide 25, because I think we do need to talk about market history and take a long-term view of things. Not to be flipped, to use that word again. For the time being, the market just doesn't really care about how much money the government's borrowing and spending, right? It's a very Keynesian response. Step in, the government should. I know I sound like Yoda there. I'm sort of flipping my sentence structure around when no one else has any money to spend. And at some point, the debt and the deficit may be an issue. We don't know when. If anyone says they do, we think they're fibbing a little bit. For the time being, interest rates are low. The dollar is reasonably strong relative to most other developed market countries, and the bond market's behaving itself. So if the government wants to continue to support the economy, they can, and we think they should. But to your point, it's been an exceptionally volatile and unusual and unprecedented year for stocks. So I think now is a really good time to take a step back. So on slide 25, we have maybe our favorite slide, right? And we've titled it "What History Teaches Us." Really, the next couple slides, and it's a busy slide, but bear with me if you would. What we're looking at here is calendar year returns for the S&P 500 over the past 30 years. And the teal bar is what the index did for the year. And sometimes it's up, sometimes it's down. The red number, with the percentage sign and dot next to it, is the maximum drawdown for the S&P 500 intra-year. So if you go to the far right, you'll see that in 2020, the S&P was off about 34%. And then if you start to look right to left, you'll see that we only get to 30% down or more during periods of recession, right? 08, 09, the early 2000s. But you also see that the market does tend to correct about 14, 15% in any given year. So if a bear market's a 20% pullback, any given year, you're 75% of the way there. So volatility is part and parcel of investing. But if you go back to the teal bars, you notice that a bunch of teal bars are above zero and only a few are below zero. And so even with that volatility and that 14, 15% intra-year drawdown on average, the market still gives you about 10% a year. And so I think what's been really hard about this market and economic cycle is, well, obviously, first and foremost, the healthcare crisis that was the catalyst for it, right? People are sick, people are in the hospital, people have died, and it's tragic, right? And so that just adds to any angst and uncertainty and concern around the knock-on economic and market effects. But I think the catalyst for this market and economic cycle was so unprecedented that people really started to say, well, this time it is different, right? This time we won't come back. And again, at the risk of sounding Pollyannish, that's what we do as a species and particularly as a country. We just figure stuff out. So the market cycle isn't broken. The catalyst for the downturn was different, but history tells you markets go up more than they go down. And that will continue to be the case. Again, we will solve for this. And in the meantime, we'll adapt to it. And I'm comfortable saying that because we also look at what history teaches us from a business cycle perspective, which we lay out on slide 26. So this data set goes a little further back, and we look at economic data in the US back to 1900. And the teal bars, again, are periods of expansion, and the darker bars are periods of contraction. And you see a couple things. Over the last 120 years, the economy's expanded a heck of a lot more than it's contracted. And over the last 30 or 40 years, those expansions have gotten longer and longer, right? And that's not going to change either. Again, the catalyst for this recession and this bear market is awful. It's unusual. It's hurt millions of people, obviously not just financially, but from a healthcare perspective, and killed 150,000 Americans and more around the world. But again, we will figure this out. And so if the market cycle is not broken, and it's not, the business cycle isn't broken, which means the economy is going to expand more than it contracts. And the expansion's already begun, right? February, March, April was a contraction. May, the economy started to inflect higher. So if the business cycle is intact, that means more expansion than contraction, which means wealth gets created. That wealth finds its way through the stock market in the form of earnings and dividends, and that's what pushes risk assets higher. So we can suffer through terrible periods of down markets and economic contraction, but over time, economies expand and wealth is created, and that gets reflected in the rise in stock market. And I think that's really, really important for all of us to remember, especially when you go through a period like February, March, and April. And then if I could, another slide on market history, which I think is particularly relevant right now, given the volatility of this February to July period. And what we're trying to do with this somewhat busy slide is look at market returns and think about market returns and investing and trying to time the market. So you see 4 data points there. And if you back up to the beginning or the left-hand side of the slide, it's 20 years ago. And the idea is, okay, I'm going to take $10,000 and invest it in the S&P 500. Now think about what you had to live through over those 2 decades, what you had to look past to stay optimistic about the country and the market, right? The horrific events of 9/11, that bear market, the Great Recession, the housing bubble bursting, and then this awful pandemic and the worst downturn in our economy since the Great Depression. And all the angst and all the negative headlines and all the naysayers that go with all that, and not without good reason. So if you're able to look through those troubled times, that $10,000 would now be worth north of $37,000, even with 3 awful bear markets, an horrific terrorist attack, and now a pandemic, right? That's how wealth gets created, time and compounding. But say you couldn't handle the volatility. And again, this is why we think people should work with financial advisors. and you couldn't handle the headlines and the angst. So you thought, I'm just going to get out and get back in. I'm going to wait till the skies clear. We've already talked about if you wait till the skies have cleared, the plane's already taken off. It's too late. So if you jumped in and jumped out of the market, but you managed to miss just the 40 best trading days over those 2 decades, less than 1% of all trading days, instead of having $37,000 in your pocket, your $10,000 would be worth a little bit north of $5,000, right? And we know time in the market is hard. It's hard for a couple of reasons. One, no one has that crystal ball, but what makes that dynamic even more difficult, is that the market's best days often follow on the market's worst days. Just think about it, right? February, the market peaks. It goes down 34%. March 23rd, it bottoms. Trades higher through the end of March, all of April. We lost 20.5 million jobs in April, and the market just went straight up. And those best days followed on some of the worst days in decades. So if you can take a long-term view, if you can have your time horizon work for you, please try and do that. And obviously work with financial advisors like Eric and Rob and their colleagues. And before I turn it back to you, Eric, just a couple thoughts on the history of this awful pandemic we think will write. And we lay some of those points or questions out maybe on our final slide 28. This pandemic has already written all sorts of history, right? 20.5 million jobs lost in 1 month, a post-World War II record. Post-World War II unemployment rate, all-time high of 14.7%, an unprecedented fiscal and policy response. It just goes on and on. But we think the history of this pandemic will write, the more meaningful history will be written over the next few decades, not days. So the government's borrowing money hand over fist. That could be inflationary if the economy really opens up, or all that debt could prove to be deflationary. So we're paying attention to that. The European Union was struggling mightily before this pandemic. There's a chance that it could always rip the European Union apart, though it seems like for the time being, the EU is coming closer together. We think that's a good thing. There's talk of onshoring U.S. manufacturing, not just from China, but other countries, particularly in sensitive parts of the economy like healthcare and aerospace. That could happen. And then we have the U.S.-China dynamic. It was all about trade the last couple of years. We think, honestly, it goes way beyond trade. You've got the world's 2 largest, most important economies, the world's 2 largest and most powerful militaries, and you've got very different operating systems, different ways of running economies and different ways of running a country. And so we think that dynamic and how we all saw for an ascendant China bumping up against an established America, that more than anything, I think will determine the type of world we all live in and our children and our grandchildren live in from an economic and a geopolitical perspective. So that's going to play out over a very long period of time. And then the government's spending a lot of money. And there's talk about making some of these programs permanent. If you go back to 08 and 09, the Federal Reserve and the federal government stepped in. They bailed out Wall Street. They bailed out the automobile industry. They made a profit on those investments, but they wound down those programs. There's a chance this extraordinary spending over the last couple of months, some of that leads to a larger, more permanent, more established U.S. social safety net. So those are the kinds of things we're paying attention to, because over time that will have a huge impact on the economy and risk assets. Some of those things may come to pass. Obviously, none of those things may come to pass, but we think the consequences of this pandemic, even if we solve for it tomorrow, and good Lord willing, we will, from a treatment or a vaccine perspective, is going to be with us for a very long time. So with that said, Eric, why don't I turn the presentation back to you?
Awesome. Thanks, Tim. It's always a pleasure chatting with you about the markets and economy. I'm not going to lie, a little more enjoyable today than maybe back in March and April, but hopefully even better going forward. So with that, I guess I'll turn it over back to Rob to field some questions.
Thanks, Tim and Eric. That was a lot of good insight. I appreciate everything that you guys mentioned. If I can make one comment there, because again, as Tim mentioned, it was good that you ended on this slide with what history tells us. Being on the front lines, dealing with individual clients, I can't tell you how many phone calls we received back in March and April when things were looking pretty ugly. Like you said, March 23rd was the bottom. We received a lot of phone calls. And the very first question that I would ask any client is, has something changed in your life to warrant a change in your overall allocation or your overall financial picture. And I would tell you all but one said no, nothing has changed. They were just fearful about what was going on in the markets. And so my follow-up response to those individuals would be, well, then why would we make a knee-jerk reaction in your portfolio based on the daily fluctuations of the market? Of course, we're in an unprecedented downturn. And as you mentioned, everyone seems to always think this is the worst, this is the worst. But as you've shown us throughout this presentation, that we have been through a lot of unprecedented times. And as you mentioned, markets tend to want to increase over time. So what I would tell all those individual clients and all those clients that we work with is stay the course. We have a long-term time horizon and a long-term view, and things will get better, but never make knee-jerk reactions based on headlines or what is going on in today's world. Because as you mentioned, the typical investor typically buys high and sells low, when in reality, we want to buy low and sell high. So with that, I'd like to get to a couple questions. We do have some questions here, and certainly chime in, Tim, Eric, if you have some insights on it. I'll take the first one. What happened to the bond market in the downturn?
Yeah.
So, Tim, do you have some thoughts on that?
Yeah. Yeah. So at a high level, when the economy started to roll over and equity started to roll over, you saw a fair amount of forced selling, people trying to raise capital, selling what they could. And the other side of the trade just wasn't there. The bond market has changed somewhat structurally following 08 and 09 and the way capital markets, companies, banks are allowed to behave. So folks were trying to raise capital, go to cash, raise cash, and there just was no one to take the other side of the trade. And so the bid ask, which is the difference between what someone is willing to buy a security for and sell a security for, just widened dramatically, which was reflective of just little liquidity. And so what's interesting is, and if you go to the Federal Reserve's website, you can read the press release. They put out a press release on March 23rd, the day the stock market bottomed, announcing that they were going to be setting up a number of special purpose vehicles to invest in certain fixed income securities. And the interesting thing, and this gets back to the fact that the Fed's got about $2.5 trillion in capital left on its balance sheet, most of those vehicles, because they take a while to dial up and structure and then fund, weren't going to be in place until early May. So about 6 weeks from the time of the announcement. And almost to the day of the Fed just saying that they were going to be stepping in, liquidity started to come in on the other side of the trade, or people stopped selling because they weren't worried about the ability to sell down the road. And so you just saw those spreads come in, those bid-ask spreads we talked about in the high yield market earlier in the presentation. And that's reflective of improved liquidity, improved trading conditions. And it was just the promise of support that got the markets unstuck, which is why the Fed now still has $2.5 trillion on its balance sheet to go out and buy mortgage-backed securities and treasuries and investment-grade bonds. But they kind of don't even need to, because the private buyer has come back, and those buyers ran away just out of sheer fear in late March.
Yeah, it was definitely a scary time because
it was
looking for safety, and the bond market is going down. That's not exactly what you want. You want to be in a safe asset. Bonds are typically safe, but we had, like you said, and it reminded me of 2008, 2009, where you couldn't hide anywhere. You know, equity markets, bond markets, everything was going down. So it was definitely a scary time. So thanks for the question.
Yeah.
Thanks for the response. Next question we do have is GDP came out today and was lower than expected. Is that good? So GDP was, I believe, 32% negative. I think they were expecting 34 and change. So it did come out a little bit better, but it was still a negative 32%. So thoughts on that?
So quick thought, I just put the number in perspective and I'll let Eric talk to what it may mean. Just for those folks who may be watching, you know, that's the annualized number, right? So if the rate of change in Q2 was what the economy would look like for a full year, that's what you would get. So it's not as scary as the number looks, if that makes sense. So again, it's a shockingly bad number. I'm not trying to minimize it, but they annualize that number, which makes it look even worse than what really transpired in the quarter, just because of the way they measure the economy Q to Q. But I'll turn it back to Eric to kind of talk to what that GDP print means for all of us.
Yeah, I mean, I agree. I think that when you annualize these numbers, it makes it a little bit scarier for the layman. But 32% annualized is not a good number. I don't really think there's any great way to say that's an optimistic number to look at. However, I don't think you can look at this in a vacuum. I think that we need to see going forward how the economy will respond. So, 32% down quarter paired with a 32% up quarter next quarter, or double digits next quarter, followed by high single digits or double digits, and you start seeing that gap get filled in. I think that'll tell a much fuller story and kind of let us know how the economy is responding. We knew this number was going to be ugly, just like back at in the early months of this pandemic. We knew that the unemployment number was going to be ugly, but the numbers are so much higher than what we're used to seeing that it's almost impossible to look at one data point in a vacuum and make any kind of long-lasting judgment on it.
Yeah, no, I would agree. That's exactly right. I mean, we're going to have to see what the future holds for the next 2 quarters, which hopefully we should be seeing a significant rebound. As we mentioned during that presentation, we do foresee the market really rebounding and the economy really rebounding, which it already has to this point. So great answer, great question, guys. So next question, Tom McNeil, very good partner of ours, known Tom for quite some time. He had a question, and I get this question actually a lot. Is a handful of tech names, so the FANG, your Facebook, Amazon, Apple, Microsoft, and Google. Netflix and Google seem to have led the recovery and make up a large percentage of the S&P 500. Is this healthy, and do we have any comments on that? Yeah, they do make up a very large percentage. Tim, do you know exactly what the percentage is? I know it's a very high. Eric?
So I believe that handful of stocks, at least in the Russell 1000 growth, which is a large cap growth index, it's different from the S&P 500, but Facebook, Apple, Amazon, Netflix, Alphabet, we used to be Google, Microsoft, I think it's about 40% of the 1000 growth index. It's a shockingly large number. And I think within the S&P, it's 25%, it's 25% of the index. It's just massive. And so usually when you see those kinds of weightings, you think bubble, right? Everyone's at the party. Everyone owns these stocks. There's no one left to buy them. They're disproportionately represented in these indices, and trees don't grow to the sky. For the meantime, at least, and growth investing goes way beyond that handful of stocks, we still like growth companies over value companies because the recovery, while strong near term, is still nascent. And the basic idea is in a slow growing or no growth economy, which is what we lived through for a little bit, investors will gravitate toward those companies that can grow almost independent of the business cycle. And then as the recovery broadens out, picks up steam, hopefully you actually see a little inflation bubble up, other parts of the economy, or at least other parts of the market will do better. I, like all of us, the late 90s, I was around, late 90s, early 2000s, the tech media telecom bubble bursting, the NASDAQ went from 5,000 to under 1,000. It was an 80% plus correction. It was awful. These companies are not pets.com, right? For those of us who remember some of those IPOs, these are companies with trillion plus market caps, at least some of them, hundreds of billions of dollars in capital and cash on their balance sheet. And at least in the case of Amazon and Microsoft and Facebook and Amazon, have network effect businesses that just become more powerful each day, right? Each package one of us buys from Amazon tells Amazon a little bit more about who we are, how we spend our money, what we like, and makes us become a little more attached to that that value proposition. So history tells you someone will disintermediate Jeff Bezos at some point in time, or Tim Cook. We don't think that's going to happen anytime soon. And we also don't think, again, the performance of these companies, the weight they have in these indices, it's always dangerous to say it's different this time, but these are not late 1990 internet darling companies. These are global multinational behemoths that have some of the best balance sheets the world's ever seen. So that's kind of a non-answer answer, but hopefully that provides some perspective.
Yeah, and to that same point, I think during this downturn, people went to what they see as safe investments. So the biggest investments, the biggest companies that you're using every day, which is Google, buying everything on Amazon, going on Facebook. So I don't think it's any surprise that people would invest in what they know, the old Warren Buffett adage. But I think it just is sort of a perfect storm for these companies, because at the same time, we're in a weird environment where these companies also seem to be in a benefit the most from our current environment. So everyone is using Zoom. Zoom is hosted somewhere, probably on Azure at Microsoft or AWS at Amazon, maybe even Google. We're all talking to each other over the internet. All of our servers are hosted on one of these cloud computing companies. And so I think it sort of makes for a perfect storm where people are putting money into these companies for safety and also for speculative reasons. And I wouldn't say that is a bubble scenario. Like you said, they're not shipping 50-pound bags of dog food across the country through USPS.
Great. Thanks for the responses, guys, and thanks for the questions. We have a real quick minute. I want to end on one last question, because I think it's what is coming in the near future and what it is from a pure financial market standpoint. Who does a market want to see as the next president? And we can all answer that. Honestly, we can look at history with the way the markets have reacted. And as Eric, I think, had mentioned, and Tim, you had some insights into this earlier, I don't think the market necessarily cares about politics. I think it's all about policy. So it really depends on, in my opinion, who controls Congress, the House, obviously the presidential seat. So it's going to be a matter of what happens as a whole, as it's necessarily the president, because that's going to determine who is going to be making the policies. One quick thought, Eric and Tim.
Yeah, I mean, I'm sure you've heard me talk to this many times since 2016, which is that it doesn't seem like the market really cares too much about politics. I remember reading a now infamous op-ed from a Nobel Prize winning economist back in 2016 saying that if Donald Trump won, the stock market might never recover. It finished the year up, 2017 was up, and now it looks silly reading that. But I think the main takeaway from that is that the stock market is really good at allocating capital. And so whoever wins, people will put their cash that's sitting on the sideline into the most profitable spaces in the market. And so you might not see the market respond in the same way to a Biden presidency or a Trump presidency, but I think that people aren't going to miss out on investment opportunities for political principles. I don't think so.
And I would just add, those are not much to add to either Rob's answer or Eric's answer, but while we're all going to be focused on the presidential race, keep an eye on the Senate, right? That's most likely to give you divided government today, if you believe the polls. So I think the race is closer than some of those polls indicate. So I'd pay attention to the Senate, because you need one party to not just win the House and the Senate and the White House, but by meaningful gaps on the Hill, meaningful margins to enact meaningful fiscal policy changes. So I'd pay really close attention to the Senate. And then to piggyback on what Eric said, whoever sits in the White House from a regulatory perspective, they can have a meaningful impact on specific industries from a regulatory perspective, from a regulatory fiat sort of perspective. So That's where active management, stock picking can add a lot of value. But from a big picture perspective, the Senate, I think is worth paying attention to, because if you come out the other side of this and you have divided government one way or the other, professionally, I think the market's going to be more than okay with that.
Right. All right. Well, with that, I appreciate it, Eric. Tim, thanks for the insights today. It was great. I know they will be available for follow-up. Obviously, our contact information will be listed. It's at the bottom as well as at the end of the presentation here. There are a handful of questions that we did not get to, and I certainly apologize for that. We will try to reach out and get the answers to those questions as soon as we can. As always, if there's anything that we can do here at the Capital Group, we are ready and available to answer any investment-related questions, portfolio-related questions that anyone might have. But I appreciate everyone's time, and I hope everyone has a safe and healthy weekend. And thanks for joining us today.